The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to Reverse Mortgages 101. My name is Anthony Monteleone and I'm with Reverse Funding Education and Training. Let me get started today with today's agenda. I'm going to cover some reverse mortgage terminology as well as history, and I'm going to go over some facts and characteristics. I'll talk about consumer protections that were put into place. I'll speak about borrower and property eligibility, and then talk about products and payment options. And then these next two, these are two niche products that are available. They're HECM to HECM refinance and HECM purchase. Now we have some classes that are specific to these subjects that go into further detail, and I encourage you to check them out when you have the time. And last but not least, I'm going to go over reverse mortgage workflow. So on to some reverse mortgage terms. This is to give you a broad overview of the reverse mortgages. We have some classes, as I mentioned earlier, that go into more details about a lot of things that we're going to discuss today. And again, I encourage you to take those as well. HECMs. Well, HECM is a home equity conversion mortgage, and HECM loans are insured by HUD. There are some proprietary reverse mortgages out there, but they're not insured by HUD. Only HECMs are insured by HUD. And 95% of the industry are doing HECM mortgages. Maximum claim amount. That's the lesser of the national lending limit, which is currently at $625,500, or the property value. Single family limits apply to all property types. Principal limit. That's basically the loan amount, and that's determined by the borrower's age, max claim, and expected interest rate. Older borrowers receive higher proceeds. So if you have two borrowers, same exact situations, except one borrower is 65 and the other borrower is 75, the 75-year-old borrower will receive higher proceeds. Counseling. Well, that's something that is required and must be conducted by a HUD-approved counselor prior to services being ordered. A best practice for this is for the borrower to attend counseling prior to application. And in some states, and I'll show you a little bit later, this is a requirement. Mandatory obligations. What that is, it includes payoffs, closing costs, repair set-asides, taxes, and homeowners insurance required by the lender, and these are all paid from the proceeds of the loan. Simply put, if a borrower has a $50,000 mortgage on their property, and they have $10,000 in closing costs or mandatory obligations, their total mandatory obligations are going to be $60,000. Mortgage insurance premium. Well, this is HUD mandated insurance guaranteeing that the borrower will receive the promised loan advances and not have to repay the loan as long as the loan is outstanding. And there are two types of MIP. The first one I'm going to touch upon is upfront or initial MIP, and that's either 0.5% or 2.5% depending on the borrower's mandatory obligations. And I'll show you an example of that in a little while. The other type is the ongoing MIP, which is added to the loan balance each month at a rate of 1.25% annually. The expected rate, well, that's the rate that's used to determine the principal limit. The initial rate, also known as the note rate or the applied rate, that's the rate that is charged on the loan balance. LIBOR, that stands for London Interbank Offered Rate, and that's the index that is used to calculate HECM ARM rates. And if it's an annual ARM, we use the 1 year, and if it's a monthly ARM, we use the 1 month. Non-recourse, this is important because this is a great selling feature. Non-recourse, the home is the only source of repayment regardless of the loan balance at maturity, and all HECMs are non-recourse loans. So really, no matter what happens to their property value, if it declines or doesn't increase as expected, even if the loan is higher than the home value, the home is the only source of repayment. The borrowers don't have to worry about themselves or their heirs ever having to have any deficiency judgment placed against them. Repair set-asides. Well, since these are FHA loans, it does require an FHA appraiser to go out there. And what happens when the appraiser goes there and they note that there are some minor repairs to be done that are not health and safety related, and the appraiser gives us a cost to cure, what we do with that cost from the appraiser, we take 200% of that as a repair set aside. Now, if there is a bid from a contractor, well, we'll do the same thing, but we'll take a set aside of 150% of that bid. Now, when it comes to health and safety repairs that have to be done, those have to be done prior to closing. Repair admin fee. That's a fee that's charged at closing to cover the cost of creating the set-aside account. It's 1.5% of the repair amount, and it starts at a minimum of $50 with a maximum of $250. UPB, unpaid principal balance. That's the amount that's paid out at closing, consisting of closing cost, lien advances, and other draws paid at closing. Now, these terms, this is basically how a borrower qualifies to get a HECM, and these are fairly new. They came in with financial assessment. Capacity, what that does, it measures the borrower's financial ability to meet their ongoing financial obligations. It reviews their income and residual cash flow. Willingness, that analyzes the borrower's credit history to evaluate whether or not he or she has met the financial obligations in the past, and items such as mortgage rates, tax liens, foreclosures, and bankruptcies are reviewed when determining willingness. Life expectancy set aside, also known as a LESA, that's the amount of funds reserved to pay property charges based on the life expectancy of the youngest borrower, and it's depending on the capacity and willingness analysis. Borrowers may be required to set aside a fully funded or partially funded LESA, and the fully funded really is if they don't meet capacity or willingness issues, especially ones that can't be explained by extenuating circumstances, and it's set aside for taxes and insurance. A partially funded is another option, but that is not dependent on the borrower. It's dependent really on the underwriter if they're going to need a fully funded or partially funded. With a fully funded, what happens is the taxes and insurance are paid by the servicer. Partially funded, that means that the funds are collected and a check is sent to the borrower on a semi-annual basis to pay their taxes and insurance. And we have some classes that deep dive especially into these three categories right here. Again, I encourage you to check into those classes to get more detail on how those work. Now, history of the reverse mortgage industry. Well, back in 1988, legislation was passed by President Ronald Reagan, and in 1989, the first loan was made. The first reverse mortgage loan was made. By 1993, HECMs were available in all states except Arkansas, South Dakota, and Texas. And then in 1997, NRMLA is founded, and that's our trade group, for those of you who weren't aware that we had a trade group. And then in 2003, the housing market was going through the roof, if all of you can remember that. Of course, most of us do. And HUD limits were not keeping up with those numbers. So that's when they came out with jumbo reverse mortgages. There are lenders out there that do that, but that's when they were started, back when the housing market ballooned. In 2006, new HECM products came out. 2007, the HECM fixed rate came out. Then 2009, these are two important things that came out. HECM for purchase, and also there's a record volume in reverse mortgages. 110,000 loans were insured during that time. In 2010, HECM Saver, what HECM Saver was, it offered a lower MIP, but it lowered the principal limit. And then in 2013, there were some program changes, mandatory obligations, how much a borrower can draw the first year and after. And then in 2015, financial assessment came about, and that's when they not assessed, but added capacity and willingness to pay their financial obligations. So these are some important dates there. Now, some facts. The thing about HECMs, they are due and payable when the last borrower or protected non-borrowing spouse permanently leaves the home. It allows older homeowners to convert a portion of their home's equity into tax-free income. And that's something that you or they, if you're interested, want to consult a tax professional about. They would have better information on that, but there are some tax advantages to it. Monthly principal and interest payments are not required. That's right. They don't have to make a monthly payment. They can if they want to, and if they decide to, there is no prepayment penalty on that. Taxes and insurance are paid directly by the borrower unless it's a situation where there is a set-aside made for them. All borrowers must be 62 and a citizen or a legal resident. All borrowers must be on the deed. There are exceptions for life estates or trust. And it has to be owner-occupied or primary residence. And the borrowers, this is important, the borrowers retain full ownership in the home. And once again, we're looking at the capacity and willingness analysis to see how they handle their finances. Now, non-borrowing spouses, as I'd mentioned, some changes were made, and prior to these changes, the non-borrowing spouse had no rights if the borrower left or passed away. They now have some rights. They now have a deferral period. And what happens is there are some definitions to what a spouse would be. Definition of a spouse in these situations would be as determined by the law of the state in which the spouse and mortgager reside, or the state of celebration of the HECM mortgager at the time of closing, and who is also not a mortgager. And the deferral period is the period of time following the death of the last surviving mortgager, during which the due and payable status of a HECM is further deferred based on the continued satisfaction of requirements in ML 1407. The qualifications: they have been the spouse of the mortgager at the time of loan closing and have remained the spouse of such HECM mortgager for the duration of the HECM mortgage's lifetime. They have been properly disclosed to the mortgagee at origination and specifically named as a non-borrowing spouse in the HECM documents, and have occupied and continue to occupy the property securing the HECM as a principal residence of the non-borrowing spouse. Now, on the bottom here, basically they can stay in the home for the rest of their life, but have to maintain it and pay taxes and insurance on the property. So that's how the non-borrowing spouses have been protected. Protecting mature Americans. This is very important. They are a protected class, and again, some of these things are going to be something that I've already mentioned, but it's important to know that there are protections in place. Once again, HECMs are non-recourse loans. They do not have to be paid back until the last occupant leaves, and at that time, it's either the value of the property or the loan amount, whichever is the lesser of the two. They have to go through HUD-mandated counseling by an independent third party. We want them to know all about HECMs and how they worked. There is no prepayment penalty. Once again, pre-counseling, application, and closing disclosures are provided, as well as required redisclosing. What that means is we need to, on an annual basis, send out disclosures to make sure that this is still their primary residence. Fixed rates or interest rate caps are put in place, and there's origination fee caps. And as I mentioned on the prior slide, there is protection now for non-borrowing spouses. And once again, the analysis of capacity and willingness to ensure sustainability. We want to make sure that they can sustain their lifestyle throughout the entire life of the loan. Property eligibility. Well, these are the properties that we lend on. Single family, 2 to 4 units, as long as 1 unit is the borrower's primary residence. And it says there refi only. There can be exceptions made on a purchase. We're particularly looking for if they have a history of being a landlord. That's very important. Manufactured homes, condominiums, and PUDs, as long as they're FHA approved. Now, non-eligible property types: investment properties, vacation homes, co-ops, bed and breakfast. New construction without a certificate of occupancy. Well, it is a HUD guideline on existing properties, but if they can get a C of O at least 1 day prior to the application, we can work with that. Now, borrower eligibility, satisfactory credit. You're going to find this different if you're coming from a forward mortgage world. Now, when we look at property taxes, we're looking to make sure that they're current with no arrearages within the last 24 months, so within the last 2 years. It includes all taxes. If there is a deferment program in place, it must be documented and can be excluded from the analysis as long as the deferral period will be in place until the death of the borrower or the sale of the property, whichever occurs first. Hazard and flood insurance. The policy must be current and in effect for a minimum of 12 months. Now, we know in some cases they may not have a mortgage and wanted to save money, so they didn't have hazard and flood insurance. So in that situation, what they just need to have a deck page from an insurance agent and pay 12 months at closing. Homeowners Association, PUD or condo dues, current with no arrearages in the prior 24 months. Now, mortgages and installment payments, they must be on time for the previous 12 months and no more than 2 30-day lates in the past 24 months. So in month 13 through 24, they can have 2 30-day lates. Closed-end debts do not have to be included if they will be paid off within 10 months and the balance of the payments of all such debts are less than or equal to 5% of the mortgage's gross monthly income. Revolving, no major derogatory credit in previous 12 months, and those shall include any payments made more than 90 days after the due date or 3 months or more payments more than 60 days after the due date. So you see that's somewhat different than a forward mortgage. Continuing with credit, collections or charge-off. We must determine the reason for collection or charge-off, and if they are $2,000 or more, 5% of that will be counted as a liability. Judgments, HECM proceeds cannot be used to satisfy the judgment. If there's a valid payment agreement, they must have made at least 3 timely scheduled payments, and the lien cannot supersede the HECM lien. Delinquent federal tax debt. Borrowers with delinquent federal tax debt are ineligible until resolved. The debt can be paid off at closing with HECM proceeds, and the borrower is also eligible if he or she has entered into a valid repayment agreement showing 3 months of timely scheduled payments. Bankruptcy. Now, this is for HECM for purchase only. For HECM for purchase, a minimum of 2 years seasoning required since discharge of Chapter 7 bankruptcy, and Chapter 13 must have a minimum of 12 months payout period. And maintenance of utilities, we're looking at 14 cents per square foot. Now, borrowers that fall outside of these guidelines of satisfactory credit may require one of those life expectancy set-asides without extenuating circumstances. Now we're going to go on to capacity. I'm just going to highlight this. We basically need at least 2 years of employment history. So when we're looking at salary, current salary, we're looking for 30 days of pay stubs plus a verification of employment. Same thing with hourly, 30 days of pay stubs and a verification of employment. Now, if a pay rate has been an increase has been documented, we may use the most recent 12-month average of hours at the current pay rate. Part-time, again, employment must be for a minimum of 2 years. If a pay rate increase is documented, may use the most recent 12-month average of hours at the current rate. Overtime and bonus, again, we average the last 2 years. Less than 2 years may be considered with documentation of consistent earning for at least 1 year. If it's greater than a 20% drop from the previous year, we will use the current year. Family-owned. If they work for a family-owned business, in this situation, they cannot own greater than 25%. If they do own greater than 25% of the business, I'll discuss that in just a moment. But if they do not own more than 25%, in addition to traditional or alternative methods, we'll need corporate resolutions or other business docs, business tax returns, or Schedule K-1s, or official letterhead from a CPA on their letterhead, and copies of signed personal tax returns or tax transcripts. I'm going to skip over commission for a second and get to self-employed borrowers that do own greater than 25%. The average gross self-employment income earned over the last 12 years or the average gross self-employment income earned over the previous 1 year. So what we'll need in addition to the traditional methods, we'll need complete federal income tax returns, including all schedules or 4506, 4506T, 8821s, as well as corporations and S-corps. They need a business credit report, and they may also require a year-to-date profit and loss statement. Now I want to jump back up to commission. Commission, if it is less than or equal to 25% of total earnings, we're going to use traditional. We're going to need 30 days of pay stubs and a verification of employment. If it's greater, we're going to look at total earnings. We're going to obtain signed tax returns and include all applicable schedules for the last 2 years or 4506T. Capacity continued. Okay, there's other income sources that are more likely to happen for income sources. So let's take a look at some of these other things and documentation that we need. Let's first off look at disability benefits, Social Security retirement, and military pensions. Those three, we just need the awards letter for those three items. Okay, and we need to see that it continues for at least 3 years. Now for other items on here, Social Security disability, pension, and IRA 401k income, we will need, aside from the awards letter, we will also need tax returns and bank statements to verify this. Now let's get on to some of the products. HECM products, well, two obvious ones. Adjustable rate mortgages, they're offered with a variety of margins as either a monthly or an annual adjustment. The note rate is based on the 1-month LIBOR index plus a margin or the 1-year LIBOR index plus a margin. And there's ability to draw funds using multiple payment plans. And fixed rate, simply, it's a closed-end loan. It's offered in a variety of rates set by the lender, and proceeds are taken as a full draw at closing. Some of our payment options, lump sum. Well, they could draw all the available funds at closing, and that is the only option available on fixed rate loans. This is also available on ARMs as well, but they can also get other options as well. A line of credit, when payments when the borrower requests a disbursement, as long as there is available line of credit. Tenure, that's equal monthly payments for as long as the borrower occupies a property as his or her primary residence. Another option is term, equal monthly payments over a fixed period of time. So say, for instance, the borrower knows, the next 3 years they got perhaps a child's college education that they need to pay for, and they know every month it's going to cost them this much for the next 3 years. Well, they could set that up for the next 3 years where they're going to be getting the payment for that fixed period of time, and at the end of that 3 years, they no longer receive those payments. Modified tenure or term, same characteristics as a term or tenure plan above, but it also adds a line of credit feature as well. Now, calculating proceeds in year 1. I may have mentioned earlier about mandatory obligations and that the fact HUD put in some limits on the amounts of proceeds a borrower can get in the first 12 months. Now, you may be saying limits, that doesn't sound good, but it's not. It's not bad at all. What it did, it also is when a borrower had a low utilized loan and monthly obligations of less than 60%, it reduced the upfront MIP by a lot. It reduced it from 2.5 to 0.5%. And if you look at the examples below on the top line there, if the monthly obligations are less than or equal to 50%, the maximum proceeds in the first 60 months can go up to 60%, and the MIP paid is 0.5%. That's the one option that they have, the only option they have in that situation. I'm going to skip over the middle and go to the bottom. On the bottom, if the monthly obligations are greater than 60%, they could go up to the principal limit plus 10%, but the MIP paid, the only choice they have there is 2.5%. Now the middle there, let me touch that because that'll kind of clarify it and bring it all together for you. The middle is the only group with a choice. If they're anywhere from greater to 50% up to 60%, they could get maximum proceeds up to the PL plus 10%, and they have an option of drawing additional 10% over and above the monthly obligations. But they do have an option on what they want to do. If they go up to 60% of monthly obligations, it would be 0.5%. Over 60% would be 2.5% in MIP. And let me clarify that just a little further. So they have an option of what they want to pay, because if they have, say, 52% in monthly obligations and choose to go up to the 10%, then they will pay the 2.5% because they'd go over 60% monthly obligations, and that would be at 62%. However, they could also choose to go up 8%, and that would bring them up to 60%, and they would still remain at 0.5% of MIP. So that's a way for them to look at it, a way for you to look at it. So they do have an option in the middle there. With an ARM loan, they could select that to set up payment plans. A traditional single disbursement lump sum fixed rate products are closed end with no payment plans. So the borrower basically leaves all additional funds permanently unclaimed. This is an example of MIP and initial distribution. On the left-hand side, you can see pretty much everything is the same on both, with the 0.5% and the 2.5% up until where it goes to principal limit, where it stops at $102,000. On the left-hand side, they have lien payoffs of $75,000, total mandatory obligations of $79,000, with an MIP of 0.5%, with a principal limit of 47%. So they're below the 50%. And the maximum cash to borrow within 12 months is $21,500. And their principal limit, including max cash, is at 60%. On the right-hand side, with a 2.5% MIP, now the lien payoffs are at $97,500, and closing costs of $4,000, repair set aside of $5,000, making their mandatory obligations $106,500, bringing their principal limit up to 67%, and the maximum cash to borrow within 12 months is $17,000. And that would bring their principal limit percent, including the 10%, up to 77%. So they went from 67 up to 77%. So these are some sample numbers here of a 71-year-old borrower, a $300,000 home value with a $75,000 payoff. Now, the part that I want to point out to here are the maximum proceeds. The expected interest rate on both, these are fixed and an adjustable. The maximum proceeds are based on the expected interest rate, and that's set at 5.06. If you look in the middle here under calculations, the home value, maximum claim amount, all the way down to percent of principal limit, all the way down to available principal limit, all those numbers are the same. Okay, now where it shows here the percent of principal interest, both can go up to 60%. But remember, on a fixed rate loan, borrower can get 60%, never get more than above the 60% on a fixed rate loan. And this is just a comparison to show you the difference. Now, if we continue going down, the available funds and requested payments, the max available cash on both of these at closing are $17,778.05. These both first year. But with the ARM, they could also establish a line of credit at $68,400. You can't do that on a fixed rate. And the line of credit available after the first year, again, is $68,400. And that's not available for the fixed rate. So if you go all the way down to the bottom, the unavailable principal limit, well, they have that as an ARM. They have it available as a line of credit. So there is no unavailable principal limit that's available to them. On the fixed rate, that's 68,400, that is totally unavailable on a fixed rate. That's money that they left on the table. So if you have somebody who wants additional funds to possibly use afterwards, an adjustable rate may be the way for them to go. Now, the two niches that I mentioned, this is the first one, HECM to HECM refinances. Borrowers with an existing HECM generally qualify for a HECM to HECM refinance. It's usually referred to as a streamline. Although all services are still required by borrowers, the borrowers do benefit from a reduced amount of upfront MIP. So for example, if they paid $8,000 the first time for MIP, and today it would be $10,000, they only actually pay the $2,000 difference. They don't pay the $8,000 then and $10,000 now. They just pay the difference, which would be $2,000. Although HUD allows counseling to be waived when borrowers meet certain criteria, many lenders require the borrowers to be recounseled. We do not require it. And some of the criteria, though, that they're looking at, they're looking to make sure that they get the anti-churning disclosure completed, that they're getting 5 times the closing cost, and they also had to have closed within the last 5 years. So those are the criteria that they would be requiring if they do needed to be recounseled. Now, what we're looking at is payoff amount, current principal limit, and original max claim. Those are needed, and those are needed to complete that anti-churning disclosure. Again, that has to be delivered with the application package. A HECM to HECM worksheet must be received from the previous loan servicer prior to closing. Borrowers may not qualify if original loan is in default, and the borrowers are subject to meeting all financial assessment guidelines regardless of prior HECM loan qualifications. Now, the second niche product, HECM purchases. These are something, if you're working with builders or realtors or financial planners, you may want to mention this to them. It's a great product for borrowers who are looking to really right-size their home. I don't like to say downsizing, but just right-sizing their home. Maybe just a husband and wife, they're retired, their children have moved out, and the house is too big for them. So they really just want to right-size their house. It also gives the borrowers an ability to upgrade their purchase. So this is something that a builder might be interested in. If they're looking to buy a new home that's being built, well, it may give them the ability to add some upgrades to that house. It always requires a borrower investment. The principal limit calculated the same as the traditional HECM. We do require 2 months of bank statements or acceptable equivalent, and fully executed contract to sale is needed upon submission. A C of O has to be issued prior to the application, and there are no seller concessions or credits allowed. No party to the transaction can give a credit concession. Reverse mortgage workflow. All right, we're getting down to the wire here now. So the start of the process, counseling. All borrowers and non-borrowing spouses, again, all borrowers and non-borrowing spouses must be counseled, as well as beneficiaries of a trust and POAs. Counseling must be performed by a HUD-approved HECM counselor, and they get a list of counselors, 5 local counseling agencies, and the national agencies that receive grant funds from HUD each year. Currently, there are 8 national agencies, but those are always changing. The list cannot steer a borrower to any agency, and the counseling should be done prior to application. No services can be ordered until counseling has been completed. So that's why we strongly suggest you do counseling prior to the application, no matter what state you're in. And as I'd mentioned previously, some states do have additional guidelines. The chart below is a partial list. In California, they must complete an addendum to certificate of counseling if telephone counseling is performed. Massachusetts, face-to-face is required. Vermont, face-to-face or telephone by an agency authorized by the Vermont Department of Banking. Tennessee, completed and counseling certificate number is entered prior to application. And Rhode Island, completed prior to application. So there are a few states out there, but again, I encourage you, no matter what state they're in, is that you do the counseling prior to taking the application. The application process, the borrowers need proof of age, proof of identity, tax bills, copies of deeds, death certificates if applicable, existing lien information, homeowners insurance, etc. HECM purchases, again, need a contract of sale and asset verification. Typically, no funds other than appraisal and counseling fees are collected up front, and about the counseling fees, you cannot pay for the counseling session. Counseling must be performed and the borrower must sign and date counseling certificate prior to ordering services. Data elements and an intent to apply must be received to be considered an application and present a good faith estimate. When a borrower signed counseling cert is received, the file may start being processed. Brokers order most services, including credit report, tax transcripts, appraisal and title. An appraisal is ordered according to HUD Mortgagee Letter 2009-28 regarding appraiser independence. Very important. Underwriting. Again, we analyze capacity and willingness, and there's an emphasis on the appraisal as well, since collateral is a big part of underwriting, because we're not doing debt to income ratios here, so the collateral is important. And with the appraisal, we're looking at comps, supported value, appraiser comments, and occupancy. Verified docs are signed and dated correctly, very important, and assets to close if needed. So for an example, if the borrower's mandatory obligations hit 105% of the principal limit, the borrower can bring that 5% to closing, but we do need to verify it. Repairs have to be done or set aside for if they're not health or hazard. Adequate homeowners and flood insurance has to be in place, or we need a cert, a deck page, and 12 months of payment have to be done at closing. Now, the closing itself, it's often done at the borrower's home. The HUD-1 is prepared by the lender or closing agent. The borrower is to provide voided check, positive ID, and nearest living relative at or prior to closing. There is, as with refinances, a 3-day right of rescission. And closing costs are usually financed into the loan and include, but are not limited to, title insurance, FHA mortgage insurance premium, origination fee, recording fees, and escrow and settlement fees. 99% of the time, closing costs are financed, but they don't have to be. And then after the closing, within a few weeks of funding, the loan will be boarded with a servicer, and that servicer is responsible for monthly statements, draw request, payment plan changes, occupancy certifications. It's yearly, and those certifications are just to determine if that property is still their primary residence, disbursement of lease funds if applicable, end of loan functions. For instance, the last borrower passed on, moved, or sold, whatever it might be. So the servicer would handle all those. Now, in review, let's see what we talked about. Well, we talked about, we did an introduction to history. The program was started in 1989. Terminology, we spoke about willingness and capacity and eligibility. We're looking at borrowers 62 and older. Products and payment options. We went over ARMs and fixed rates, and then we spoke about 2 niche products available in the reverse mortgage world, HECM to HECM refinance and HECM purchase, and then we finished up with the mortgage workflow. With that, I would like to say thank you very much for listening, and once again, I encourage you to check out our other classes that we have available that go into details on a lot of the things that we spoke about today. Thank you very much, and have a great day.